Hello, finance friends. In this lecture, lecture 6, we're going to be discussing the principles of investing. Now, 2 notes are in order, actually 3 notes. First, as we enter into this lecture, we're now moving into one of our next buckets of personal financial knowledge. As you recall, in an earlier lecture, I had outlined that I conceive of and teach personal finance around your activities in 4 buckets. You have to make money. You have to use that money well on a day-to-day basis. You have to grow that money through investing and protect that money through insurance. So as we move into lecture 6 on investing, we're now discussing our 3rd bucket. Second key point, our second kind of big idea here, in a later video, I'll be giving very detailed information on specific types of investments. So in a later lecture, we'll be discussing stocks and bonds and mutual funds and real estate. And we'll dig into some of the nitty-gritty on specific types of investments. But for today, we're taking it at the top level and really just hitting the principles. And that leads to my 3rd kind of intro point. In personal finance, as in life, there's principles that you always want to follow. And that means that there's principles that you need to know. Finance in particular, like life, but finance in particular, it moves very quickly. There are innovations that are in existence today that weren't around 30 years ago when I was an undergrad. You think about things like cryptocurrency, you think about the Roth IRA. All of these are relatively new innovations. So one of the key lessons, one of the key mantras, one of the key ideas I want you to keep in mind, technologies will change rapidly. The tools that you have available to achieve a job, they'll evolve and change rapidly. But principles are timeless. So you want to discipline yourself in investing, as in life, to always focus on principles. They're timeless. Once you know the principles for success, then you can apply those timeless principles to the changing landscape and evolution of the world around us, okay? So with that said, let's jump in. And I think one of the first questions that you need to ask is, what actually is investing? Now, there's 2 ways to think about this and answer this. One way is to ask, what is investing? Obvious. But I think it's equally important to ask, what isn't investing? You can get an idea of what investing is by thinking about what investing is, of course, but also by identifying practices that are not investing. So a fairly straightforward definition. You can think about investing as a long-term process in which you take some of the money that you have saved and you deploy it. And you deploy it, you set it out there in the market with the expectation of profit, but with the understanding that there is risk and you might lose some or all of it. Within that definition, you get a few different big picture pieces here. First of all, investing is a long-term process. We are talking about decades. Now, technically speaking, if you take some spare cash and you put it into a CD or you put it into a money market account to get some interest for a few months, that can be seen as investing because you're deploying spare capital. But in this context, we're talking about, in the classical sense, with stocks and bonds and mutual funds and real estate, we're talking about investing as a long-term process. Second thing, you have to deploy money that you own. In other words, you have to take some of the capital that you have saved and you need to put it out there. Use that capital to purchase investment assets, mutual fund shares or stocks or bonds or real estate or whatever else it is. Notice that this idea of savings goes back yet again to one of our key core principles. You have to run net cash flow positive. You have to live below your means. You have to spend less than you earn. That is the only way, by definition, that you can accumulate a base of capital which can then be deployed in the market into assets that you can invest in. So you're going to save some money and deploy it with the long-term focus. And finally, you're going to expect profit and hopefully earn profit, but all investing has risk. And therefore, all investing needs to be understood as risky. And when you begin investing, you need to understand that there is a probability that some or all of your capital could be lost. Now, there's ways and there's strategies that we can employ to reduce the probability of that loss, and we'll get to them today, but just know there's no sure bet. And anybody who says that they have a foolproof system or that they have a way where you can invest and make unlimited upside gains with no downside, that's probably not the case, because all investing has risk. Now, I mentioned earlier that investing is our third bucket of activities. We're growing our wealth. So the goal of investing is to accumulate and grow the wealth that you need to meet your goals. And that takes us back to another core principle. Ultimately, personal finance is about your goals. You have to decide what those goals are for you, for your family, both for you presently and for future you, for your current family and your future family. Okay, so we're trying to achieve goals. We know that we have to have wealth to achieve those goals, to pay for those goals. So the goal of investing is to accumulate that wealth. But again, I want to remind you, the end result here is not the money. The money is simply a tool that helps you to achieve the bigger goals that you've set for yourself. Okay. I mentioned in our definition that when you invest, you deploy funds. The question then is, where do you deploy those funds? In other words, what can you invest in? We call these things in finance asset classes. Asset classes are basically the categories or the building blocks of your investments. So the most traditional, typical asset classes in investing would be things like stocks, bonds, mutual funds, which are basically funds that consist primarily of stocks or bonds. You could deploy your money and invest it into real estate. You could theoretically, if you chose to, if you had a very, very, very low threshold for risk, you could just invest your money in cash assets, money market accounts or CDs. And then there's a whole other range of new, they're not even new, but a whole other range of really more esoteric, what we'll call alternative investments, gold and silver, art, collectible cars, lots of other things, commodities, and there's a whole other kind of array of alternative investments, which are viable for some people. I would not recommend them to you as a beginning investor, but they're viable. So the big picture here, where can you invest? Where can you deploy your funds? We call these asset classes. One of your big goals as an investor is to determine which asset classes will you take part in, and within your whole portfolio, how will you divvy up your investment dollars into those different assets? A lot of people think that investing is very complicated. It does not have to be. I would suggest to you that ultimately, successful investing simply comes down to owning some pieces of America's or the world's best companies. That's really what it is. Whether by buying stock and actually owning shares or by lending companies money through the bond market, ultimately, successful investing just means having a piece of our nation's and our world's best companies. If you do that, you can reap the rewards If you own stocks, that's in the forms of dividends and growth. If you lend companies money through the bond markets, that's in the form of interest that they pay you back. But basically, if you own little pieces of all the world's best companies, you will own a piece of the rewards that those companies generate. And that is how you invest. And it's not very hard. You can make it hard. You can make it complicated. But that's really what it comes down to. So that to me is what investing is. I think we should also ask the question, what is not investing? And I think here that primarily things like speculating, that is not investing. Day trading, that is probably not investing. That's speculating. You're trying to get momentary edges and outperform other traders. That's probably not investing. You can call it trading, you can call it speculating, but it's not investing, okay? And I would recommend to you that, especially when you're starting your journey, you have no business doing those things. Stick with the principles, invest for the long term, watch your money grow, okay? I want to start by giving you what I've distilled down to be 8 principles of successful investing. In other words, these are not, notice I don't put anything in here. I put a bit about index funds, but nothing about valuations and nothing about what stocks to buy and how to track the prices. None of that. Broad principles that you should follow to invest successfully. Now, some of these may seem pretty evident. You may have heard them before. A few of these might be new or even counterintuitive. But this is what I offer to you as 8 principles for successful investing. Number 1, keep it simple. Minimize motion, keep it simple, and follow what we call a passive investing strategy. Second principle, for some people, makes sense. For many people in today's market, very counterintuitive. Do not attempt to beat the market or time the market or chase performance. You will not succeed in this, okay? Many people think they can. Lots of people actually do beat the market in a very limited short-run window. But over time, you probably cannot do that. So don't even try. Number 3, you have to know some basic ideas and some basic terminology. So another principle of investing, know the concepts. Understand when you hear the terms asset class, risk-reward trade-off, asset allocation, rebalancing, diversification. Understand what those terms mean. Understand the role that those concepts have in a good investor's practice, and understand how you can actually achieve those things in the simplest way. Number 4, one that is very counterintuitive. It's not counterintuitive, actually. It's just ignored. Most investors, if you ask them, what's the most important thing you're going to do? They will say, maximize my return, maximize my growth, maximize my return. That's fine. You do want to get a good return, but it's equally important to minimize your fees. I'm always shocked by how many investors, they know historical data of their investments in terms of their returns, but they have no clue about their investments expense ratios, investing and trading fees. The reality is it's important to maximize returns, but the flip side of maximizing returns is minimizing fees. You must strive in any investment that you take on. Hell, for that matter, with any financial tool that you take advantage of, you must strive to pay the minimum amount of fees possible. Number 5, keep your investing life simple. I suggest that as a beginning investor, and again, this is not financial advice, I'm not telling you what to do, but the research is pretty clear. For a beginning investor, you have no business trying to buy individual stocks or individual bonds or individual investments. Instead, you'll be much better served. You'll probably get better gains. You'll get less volatility, and you'll sleep a lot better at night because your life won't be consumed by the stress of seeing that volatility if you just buy what we call mutual funds, specifically index funds or target date funds, which are two specific types of mutual funds. If you can buy those funds and then you take advantage of two strategies, one strategy called DCA and the other strategy called DRIP. Mutual funds plus DCA plus DRIP means you're going to be wealthy one day. Another somewhat counterintuitive principle: focus a little bit less on the things that you cannot control and focus much more and spend more of your energy on things that you can. A lot of times people they'll look at market historic norms and interest rates, and of course all that's important, but it's out of your control. But look at what is in your control. How will you diversify? How much money you save? Your strategy so that you don't fall victim to get rich quick schemes or other pressures. So always know that you have a limited amount of things that you as an investor can control. Much of the investing world's beyond your grasp. The market is its own thing. We can't control interest rates. We can't control returns, but we can control our temperament. We can control our emotions. We can control how much we save. We can control the fees that we pay. So focus on the things that you can control. All of this sounds very difficult, and it can be, but it doesn't have to be. The best way that you can solve all of these is to write your own personal financial plan. Develop a plan. Make it a boring plan, because in investing, boring is good. Boring makes you wealthy. So develop a plan, make it a boring plan, automate that plan, and follow that boring plan for decades. And then the last thing, which is the flip side of following your plan will help you do the right things. And the last principle is to avoid doing the stupid things. Avoid hurting yourself. And once again, having a plan that's automated can make your financial life dumb human proof, right? It can make you, primate monkey brain proof. You can just automate a plan, incorporate the best strategies, and benefit from that, and protect yourself from hurting yourself in the process. So those, my friends, are what I offer to you as 8 principles of successful investing. With that said, now let's get a little bit deeper into the nitty-gritty, start going through some jargon, start going through some concepts and making sense of things to put together a few pieces that will give you a broad picture of how to invest successfully over time. The first thing I want to talk about with you in terms of the more nitty-gritty stuff is this idea of investment accounts. Now, when you are investing, as we said in an earlier slide, you're going to be taking some of your spare capital and you're going to be deploying it. And you deploy it by buying certain types of assets. We call those types asset classes. So when you invest, you simply take your spare capital, you use that spare capital to purchase investment assets, financial assets. Those assets can be broadly grouped into asset classes, which once again could include stocks, bonds, mutual funds, real estate, commodities, currencies, artwork, all kinds of ideas. But you're investing in assets. What you have to also understand is not just what you are buying, which is the asset classes, but critically where you are holding those assets. And these are what we call investment accounts. Okay. An investment account is like a vehicle that you set up and that you invest through. In other words, you use your money to buy assets. Those assets are held in your accounts. So you can think about it that you can think of your investment accounts as a bucket. And that bucket, in turn, holds the assets that you own. So you're going to buy assets and you're going to hold those assets in your investment accounts. Now you think, well, that's logical, Eric. I had to have a place to hold it. Why do you give us this slide? Well, the critical thing to understand is in the world of personal finance, there are many different types of investment accounts. And some of those investment accounts provide very specific tax or retirement benefits. So I wanted to spend a moment just outlining for you what we mean by investment accounts. I'm going to give you a very, very top level, kind of just really broad macro view. You're welcome to ask questions or send me questions later. We can talk about this when we have some live time, video time. But basically, I want you to understand that there are different types of investment accounts. So let me just do here, I'll just call this investment accounts, which I will also title vehicles. Remember, the accounts are the vehicles that you put your assets in, and those vehicles travel with you through time. Your accounts hold your assets, but critically, those accounts, remember, they may have some particular tax or retirement benefits. In other words, my friends, there are particular accounts that you'll hold for particular purposes. There is not just one catch-all account. You're going to want to have the right tool for the right job, the right account to achieve the right goal. So let's break this down. The first type of investment account is what we're going to call a traditional brokerage account. These traditional brokerage accounts you can set up through any of the big brokerage houses, Vanguard, Fidelity, Schwab, all of those. Most people have these accounts and they hold some cash in them and they buy and sell stuff in them. Plain vanilla, very basic, not a problem. They get the job done. And for everyday use, they're good to have. Okay. But there are other accounts that might be even better. Second type of account, we're going to call retirement accounts. With a retirement account, you set up, as the name suggests, you set up the account to hold assets that you intend to utilize only down the line in retirement. Notice that with retirement accounts, you are sort of sacrificing some liquidity while you're a worker because you're setting aside money into the retirement accounts, but you're not supposed to access it until down the line when you are retired. Now, then the question is, so then why would I do that? And the answer is because retirement accounts typically provide very, very generous tax benefits, either by eliminating taxes when you pull the money out or deferring taxes. And remember, in our tax lecture, we said that our three big goals when it came to taxes: eliminate, minimize, or defer. These retirement accounts, they work in different ways, but they can allow you to minimize or defer, and at times even eliminate your taxes in retirement. Okay. The retirement accounts in turn have sub-accounts. There's different types. So there are retirement accounts that are set up by your employer. We would call these employer-sponsored or employer-provided retirement accounts. These also go by the name DC plans. DC stands for defined contribution. So if you hear a DC plan or a DC account or an employer retirement account, same big idea here. Examples of these include 401k accounts, 403b accounts, and accounts called 457 plans. All of these are retirement accounts that are offered to you based on your employer. Okay, because all of these accounts, 401k, 403b, and 457 plan accounts, they have to be set up by your employer. Now, if you have an employer who offers these plans, take advantage of them. They're really good for you. Whether you do or you don't have an employer who offers these plans, you can also set up retirement accounts for yourself. Spelled that incorrectly. Sorry about that. In other words, American tax law allows you to, if you work and you meet other criteria, which are very simple criteria, American tax law allows you to have access to your own individual retirement account, your own individual retirement account or arrangement. And this is where we get into the realm of IRA accounts. So IRAs can be, well, the accounts for yourself can be traditional IRAs. You also have what are called Roth IRAs. And for people who are self-employed, who work for themselves, there's one called a SEP IRA. So there's other types, but these are the biggies. Retirement accounts are one type of investment account. They are subdivided based on if they're set up by your employer for your behalf or set up by you for your behalf, on your behalf. Okay, and there's some examples. And then the third type that we have, and again, this is top level. There's lots of other ones. I'll give you a top level. We also have what we could call specialized accounts. And these are accounts that are set up for specified reasons. So examples might be, number one, what we call an HSA account. An HSA is a health savings account. Health savings accounts behave very similarly to like an IRA account. But whereas your IRA is money that you contribute and save and invest for your long-term retirement, an HSA is an account that allows you to set aside money for your own either current or future health needs. So you can set aside money. You can get a tax break on that money today when you put the money in the account. You can invest those funds. Those funds can grow. And then one day when either you or perhaps a family member, spouse or child has a health issue, you can tap that money and use it with no tax break. I'm sorry, pardon me, with no tax burden later on for your health needs. Another type is what's known as a 529 college savings plan. Once again, whereas your traditional IRA was money you set aside for when you're retired, and your HSA was money you set aside for a future health need, a 529 college savings plan is a specialized a specialized investment account. And with this account, you set money aside now, either for you or for a child's future or current college funds. Here's the way that this plan works. Imagine that you have a child today, child's just born, you put $10,000 into a 529 plan and you invest it. That money grows for 18 years until your child goes to college. Suppose that in the course of those 18 years, that $10,000 becomes, we'll say, $60,000. Well, normally in a traditional brokerage account, you would have had $60,000. You would have only put in 10. That would have been a profit of $50,000. You would have had to pay a capital gains tax on that. But with a 529 account, as long as the money that you make is used for a qualified educational expense, you pay no capital gain tax. Not bad if you think about it. So once again, ways to achieve your goals and to eliminate, defer, or minimize your taxes. That's all about knowing the landscape of how investment accounts operate. Okay? And that's why I give you this slide. That way, from now on, when you hear different jargon, oh, they have a 529. Oh, I have to set up my IRA. Oh, I got a new job and they have a really generous 401k. You kind of get a sense of how these accounts work and what they mean. Okay? So that's the types of investment accounts. Let's move on to another topic that most beginning investors need to think about. There are ultimately, at the broad top level, two primary strategies in the world of investing. And those strategies are called active investing and passive investing. You should know what these two terms mean. Let's start with active. Active investing, as the name implies, is active. An active investor, in essence, engages in an ongoing buying and selling and buying and selling and buying and selling of assets, trying to buy it when the price is perceived to be low, sell it when the price is perceived to be high, take the profit and use it to buy even more assets that are perceived to be underpriced, et cetera, et cetera. Okay? So active investing is the ongoing buying and selling of investment assets. Note what active investing, though, philosophically also has in it. It has in it a desire to outperform the market. In other words, to beat the market and to outperform other traders. In other words, active investing is predicated on a big assumption. That assumption being that you can identify anomalies in prices, that you can exploit those by buying when the price is low and selling when the price is high, and that by doing so, you can beat the market consistently over time. It's important to note investors differ in if they think that's viable. Active investors believe that they can beat the market. Lots of people don't believe that. Whether you believe it or not, you need to know that active investing is also characterized by high expenses, high management fees, high trading fees, and what we call churn, frequent turnover as you buy and sell, buy and sell, and buy and sell. And if you do that in a non-advantaged account, all that churn can also hit you with capital gain taxes. So that, my friends, is active investing. On the other hand, passive investing is the total opposite. Now, full disclaimer, I am not here to tell you what you should do, but I'm here to share with you theories and some historical data. Excuse me. I will say, full disclaimer, I am a passive investor. I personally do not believe that I can beat the market. I don't even want to try to beat the market. I am content to simply match the market. And that's what passive investing does. Passive investing is a strategy where you simply seek to match or mimic the market's performance. So if the market has gone up 8% a year for the last 10 years, I, as a passive investor, say, I am content to just take that 8%, marching in lockstep with the market, not trying to beat it. Philosophically, passive investing accepts that, generally speaking, prevailing market prices, the prices of assets in a market, are generally close to accurate, and that over time, individuals cannot consistently beat the market. Okay. Now, a lot of people find this to be a controversial statement. You have to make your own decision. I believe that statement, though. In my opinion, while an active investor can beat the market occasionally, and maybe even do it a couple of years in a row, it's very difficult for active investors to beat the market consistently over time. Just very difficult to do. And if you're attempting to do it, it's probably going to be a very expensive proposition, and by expensive, not just in terms of your expenses and fees, but also all the mental energy and bandwidth that you have to dedicate to studying the market and trying to find the movements and exploit them. Okay. I personally don't want to work that hard. I go with the passive approach. In addition to matching the market, I also benefit from what I believe is for me at least, a far better philosophy of I pay low expenses, I pay low fees, and I practice buy and hold. I just want to identify the best companies in the world or in the country, buy little pieces of them, own a little bit of everything, and go along for the ride and let the market carry me. Okay? So that's active investing and passive investing. I should point out that these terms can be applied in many ways. So you can say, oh, as an investor, I'm an active investor or a passive investor. But the active and passive designations can apply to individual investors, to portfolio managers in terms of the strategy of the portfolios that they run, or even of investment funds themselves. Some funds follow active strategies, some funds follow passive strategies. So it's important to know what those two terms mean. Now, I'm going to try to, just in a very quick couple of slides, share with you some of the common views that some investors have and give you my views against those. I'm trying, in other words, to dissuade you from what are, in my opinion, pretty dangerous opinions and pretty dangerous views in the market. Again, you're welcome to disagree. I encourage you to do your own research. Clearly, there will be people who watch this video who completely disagree with me, but that's okay. You know, there's always room to learn and get better, but at least know the principles and then do your homework and your own research. But I'm going to ask the question now. Can you beat the market? Obviously, active investors say, I can, and passive investors say, no, I probably can't. So here's an opening question. Can you beat the market? And historically, at least, the passive strategy has been proven. Oh, I shouldn't say has been proven. The passive strategy appears superior to the active strategy. There's a lot of data on this, lots of different studies. One of them reported that in a 15-year period, 90% of actively managed funds failed to meet the benchmark. Now, what's the benchmark? The benchmark is simply the percentage rate that a market index reaches. In other words, you find an index that sort of mimics the whole market, and you take that index's return. So, for example, the S&P 500, the Standard & Poor's 500, it's an index. It's an index that tracks the value and the growth of the stocks, I should say, of the 500 biggest companies in America. So there is a Standard & Poor's 500 list. It's got the 500 largest companies in America. The S&P 500 index is an index that tracks the performance of the stocks of those 500 companies. This is known as the benchmark index. So if you're going to be tracking how well you do, you might compare yourself against an appropriate benchmark index. The only way to see, am I doing better or worse than the market, is to compare yourself to the market by tracking the benchmark index. Okay. Notice, by the way, that if you're a passive investor and you just buy index funds, the market benchmark index return rate is also your return rate, which makes your life very simple. Anyway, going back to this slide, a recent study illustrated that within a 15-year window, 90% of actively managed funds, and I want to point out, this is not funds run by me and you. These are funds run by Wall Street professionals, some of the smartest, most intelligent people in the world who devote themselves full time to the market and who have access to far more information than you and I have. These are professionals, well-paid, highly competent, skilled professionals. And even so, in a 15-year window, 90% of them failed to beat the index. In other words, 90% of professionals could not beat the market. So I ask you this question, my friends. If 90% of pros cannot do it, what real chance do amateurs like you and I have? And the answer, in my opinion, is very little. The moral of this story, over a long period of time, you probably cannot beat the market. Now, before you go getting sad and emo about that, you don't have to be sad and emo about that, because here's the beauty. You don't have to beat the market. You do not need to beat the market to generate long-term wealth. We learned in an earlier lecture about the time value of money. We learned that time is your best friend in growing wealth. So here's the beauty. You don't need to beat the market. Just match it. If the market has returned historically roughly 8% a year for the past 90 years, you just have to match that. And with time and a decent amount of savings, just matching the market will make you wealthy. So you don't need to beat the market. And that's probably a good thing, because with all respect to you, you probably can't. Leads to another question. Can you time the market? This is another big one. There's people who will say things like, well, I'm going to time my trades. I'm going to time my trade so that I buy something low and sell it high. This is known as timing the market. By definition, this is an active investing strategy because you're actively buying and selling in response to your perceptions on where you think the market is heading. But here's the thing, my friends. The market is random. The market is unpredictable. Even professionals cannot predict where it's going to go. So I would offer you this thought. Just like you cannot beat the market, you cannot time the market either. In a later lecture, I'll give you some data that shows historically what happens when people actually try to time the market. It's not good for them, okay? But for now, suffice to say, as a beginning investor, you cannot time the market successfully over time. And if you attempt to do so, not only will it be very expensive and very stressful, but it will probably cost you money and hurt you in the long run. So don't try to do it. What's the moral of this slide? The moral of this slide is this little mantra. You don't need, just like I said up here, you don't need to beat the market. It's good enough to match it. The moral of the slide here is you don't need to time the market because, and I'm going to say this over and over again for the next couple of weeks, and you're going to hear it banging in your head. Time in the market is more important than timing the market. In other words, time that you're in is greater than timing. TVM Principles 101, let time be your friend. I always share as an example, Warren Buffett, considered by many to be one of the more successful investors in the world today. Warren Buffett today is worth about $86 billion or so. But I want you to think about this. He's worth $86 billion. 99.7% of his wealth he acquired after the age of 52. In terms of numbers, not percentages, he's worth, again, $86.6 billion. $86.2 billion of that he earned after his 50th birthday, and almost $70 billion of it was after he qualified for Social Security. So it's not like Warren Buffett started off super wealthy. He is super wealthy. He has become super wealthy because he believes in these 4 keys. He takes advantage of time and the power of compound interest. He buys and holds good assets for the long term. He minimizes fees, and he avoids the dumb errors, the self-inflicted wounds that come from excessive motion and being a little bit too greedy. Okay? So time in is better than timing. The implication is clear. Invest as early as you can and invest as consistently as possible. To put this in the terms of our TVM discussion, make your investing strategy an annuity. Put a little bit of money in every couple of weeks. If you get when you have a full-time job, have a little bit of money out of every paycheck invested. Every month, have a little bit of money sent from your checking account automatically to your brokerage account. Little pieces, consistently over time, grow into big wealth. Okay, and that's time in the market. And finally, a third one, which is sort of the first two put together. there's a term called performance chasing. And performance chasing is when investors basically play follow the leader. They won't really have a strategy, but they'll see in a news magazine or in an online forum or in a financial column or in a financial cable show, they'll hear about, this brand new hot index fund or this, this brand new sector or this once in a lifetime stock or this sexy trend or idea, and then they all flood into it. In other words, they're chasing performance by trying to buy into the latest trend. Then when the next new trend comes along, they dump this trend and go to that trend. That's called performance chasing. Ultimately, my friends, it doesn't work. It's a sucker's game. First of all, we showed earlier that 90% of pros can't outperform the market. So the idea that you can chase a hot fund or a sexy fund or a hot sector is absurd, because who knows what that is. But second of all, even if you found something that was temporarily outperforming the market, it will eventually revert to the mean. Research has shown that very few people can benefit, even in the short run, from following the leader, from chasing performance. But the research also suggests that funds that were in the top 25% for one window had a better than average chance of falling to the bottom 25% of performance in the next window. So they sort of overcorrect. All this says that ultimately performance chasing is a sucker's game. But people still do it. So why? Well, one reason why is that people just don't know basic finance principles. But another reason is Wall Street and the financial services sector have a very, very strong interest in you buying and selling and buying and selling. They make their money off of those commissions. So you have to be aware of the role that marketing and advertising play in forming your opinions on your investing strategy. It's critical that you understand that the interests of a particular brokerage firm or of Wall Street as a whole are not your interests. In fact, they're often counter. They make a lot of money by you churning and buying and selling. So there's a lot of marketing and advertising that is designed to get you to buy and sell, buy and sell, buy and sell. But it's good for the industry and not good for you. So like any other sector of the economy, you have to be a smart consumer and you have to understand what the marketing and advertising is doing. In addition, there's a concept called survivorship bias. And basically what that means is this. Survivorship bias means that ideas that have not proven to be good ideas ultimately die off, right? So, in other words, think about this. You might hear about a hot fund or a hot sector, and you might hear about somebody who chases it and they make millions. And that person will be on the cover of magazines and in the spotlight. I had this fantastic idea. I followed this strategy. I did this and this, and I became rich. Fair enough. But Wall Street will not tell you about all the people who also followed that strategy and blew up. Wall Street will not tell you about all the people who followed that strategy and lost money. The financial services media will proudly show somebody who follows a strategy and made it, but they will never tell you about other people who followed the exact same strategy and crapped out. In other words, the media is biased to survivors. They omit the people who failed. But those people have just as much info for you as the survivors. So when the media and the marketing and ad sector talk about what somebody or some group achieved, you better ask yourself, is this the whole group or just the survivors? And if it's just the survivors, then it's on you to overcome what we call survivorship bias. Okay? The moral of this slide, my friends, I hate to break your hearts on this, but ultimately, selecting the next winner in advance is impossible. Trying to identify the next hot sector, sexy stock, great idea, sexy fund, it's a sucker's game. And trying to do that is like trying to find a needle in a haystack. It's just not going to happen. And it's not worth all the excessive effort that it takes you to get there. Okay, so that's that. All right. With that said, let's get off of the misconceptions, and let's now get into some brass tacks of jargon. Let's start off by talking about your portfolio. It's just jargon term. Your portfolio is ultimately just the collection of financial assets that you acquire to generate return. That's all. So your portfolio is simply all of the financial investment assets that you own, which once again would be your stocks and your bonds and your mutual funds and maybe your cash holdings and a real estate holding or whatever you have. Okay, so your investment portfolio is simply the collection of the investment assets that you have purchased with your spare cash to grow money and generate return. We said earlier that asset classes were the groups of investment instruments that share similar characteristics and that you invest in. Okay, technically speaking, asset classes are defined as a group of instruments that have similar characteristics and behave similarly in the marketplace. The main examples of asset classes include, like I've said, stocks and bonds and cash, real estate, commodities, art, precious metals, Bitcoin, et cetera, et cetera, et cetera. So those are asset classes. Ultimately, your investing goal, your goal should be to build a portfolio that maximizes your returns while minimizing your risk and volatility. So that's the key. You want to maximize your return. You want to minimize risk and volatility. Let's talk briefly about return. In the world of investing, almost all assets will offer return in two forms. In other words, I'll say it again. In the world of finance and investing, we believe that almost all investments will generate potential return to you, the owner, in one of two ways. The first way is what we call asset appreciation. Asset appreciation is the growth in the value of the asset from the time that you buy it to the time that you sell it. So if you buy a stock for $100 and 10 years later you sell it for $800, that is appreciation in the price of the asset. And when you sell the asset, you'll receive that appreciation. We call that a capital gain. But in addition, most investments also generate what's called current income. And current income refers to the cash or other form of income that the asset gives to you on an ongoing basis. So for example, talk about a stock. We just said that if you buy a stock for 100 and sell it for 800, it's going to give you appreciation. But while you own the stock, even when you aren't going to sell it, that stock might pay you a dividend every quarter. That's cash that you earn for the privilege of holding that stock. That's current income. Or take a bond. You buy a bond from a company, and later on, that company promises to pay you back for that bond. Okay. Or you might be able to sell that bond to another investor. That's asset appreciation. But while you own that bond, the company is paying you interest. That's current income. Or suppose you have rental real estate. You buy a rental property for $300,000. You hope that in 10 years you can sell it for $700,000. That would be the asset appreciation, the gain in the value of the asset over time. But notice that while you own the rental property, you're going to collect rental income every month. That's current income. So those are our two forms of gain. We can put those two forms together into this very important formula. The return on any asset is equal to the price that it's currently valued at, or the price that you sell it at, minus the price that you bought it at, plus any current income divided by the price that you paid for it. Notice that, let me go to red. Notice that this right here is your asset appreciation. This right here is your current income. And this right here is the price that you paid for it. Okay. So again, the return that you earn on an investment is the sum of the asset appreciation plus the current income divided by what you paid for the asset. That's going to always calculate as a percentage, and that is your return percentage. That's how much your portfolio or your asset has generated for you. Now, we said that we want to maximize return, but also minimize risk. And the reality is, all assets have risk. In fact, risk is the primary driver of your portfolio's return. That's critical. Risk is the primary driver of your portfolio's return. We believe in finance that every asset class has its own different historical return rates and also its own unique types of risk. So this idea of risk and volatility on the one hand and return on the other hand is really important. This is what we actually call in personal finance the risk-return trade-off. And it basically says this. If you put risk on this axis and return on this axis, you're going to have a direct relationship. In other words, if you take on more risk, you're going to expect to be compensated with more return. On the other hand, if you're looking for more return, you have to be willing to accept more risk. It goes the other way as well. If you say, hey, I don't want to take on any risk, I'm really risk averse, that's fine, but your returns will be lower as well. Okay. One way that we can show this is with the risk reward trade-off, which I just showed you here. There's another way too. It's called the equity risk premium. And it's basically a formula that says for any investor, I should say that, pardon me, for any asset, the asset's total return will be equal to the risk-free rate of return plus what we call the risk premium. The risk-free rate of return is defined as the return that you can get on an asset with no risk. Now, I know you're going to say, Eric, you just said all assets have risk. I know, I did. But in the world of personal finance, we have a couple of proxies for a risk-free rate of return. And the main one that is used is the yield on a 10-year U.S. Treasury bond. A U.S. Treasury bond is basically an IOU issued by the U.S. government. A 10-year Treasury bond is an IOU where the government will pay you back the money in 10 years and pay you interest every year until then. It's considered by investors to be the risk-free benchmark because the assumption is that the United States will not default on their bonds, that they will always pay their interest on their bonds, that the United States has a big enough population and the capacity to tax that population to such a degree that they will not default on their bond, and therefore that it's risk-free. Okay, so that's the risk-free rate. The risk premium refers to the extra return to compensate for risk. The idea here is the risk premium is the additional return that you need to offset the risk that you're taking. So let me give you an example. Let's just say that right now today, the 10-year Treasury bond yield was 5%. So that means that the risk-free rate of return is 5%. Would you ever buy a stock that can be very risky if that stock promised you a 5% return? Of course not. You say, why would I buy a 5% returning stock with all that volatility when I can get the same 5% with the risk-free asset? So then the question is, okay, so, well, to buy that risky stock, what do you need? And your answer is, you need more return. I need some extra return to compensate me for the risk that I'm taking. That extra return, that's called the risk premium. Premium just means like extra. So it's the extra return that you need to offset risk. Notice this implies that the riskier an investment is, the higher the risk premium is, and therefore the higher return you need to earn. Hence, once again, our upward sloping risk return trade-off. Okay, so that's return and risk. We talked about this before. I'll briefly address it. Asset classes and their risk and return. Historically, the three main asset classes that people had in their portfolios were stocks, bonds, and cash equivalents. Let's briefly discuss those, just so you know the jargon. Number one, stocks. Ultimately, a stock is an ownership share in a company. When you own stock in a company, you have partial ownership of that company. If I form the Eric company and I issue 100 shares of stock and you own 2 of those shares, then you own 2 out of 100, or 2% of my company. That also means that you own 2% of all my company's assets. That also means that you have a legal right to 2% of all of my future cash flow. So when you own a stock, you own a part of a company, including that company's assets and future profitability. Stocks are historically the highest returning asset class. So you definitely need stocks in your portfolio. So you can think of stocks, if your portfolio is like a rocket, think of your, sorry, I messed up. If your portfolio is a spaceship, think of stocks as your rockets. They're your thrusters. They give all the velocity. They make it go, okay? So stocks are the primary growth engines in your portfolio. However, they also carry the highest volatility. So we have a trade-off. I want to point out to you an important term, a stock index. So stocks represent ownership shares in companies. A stock index is basically a pre-established, a preset collection. You can use the word basket even. A preset collection or basket of stocks that are put together, and here's the key, in order to mimic or replicate a particular market, a particular geographical area, a particular sector, a particular theme, okay? So whenever you think of a stock index, think of it as a basket of stocks that is designed to mimic a broader market. What market is that? It depends on the index. You know, so some of the more common ones that we have, the Dow 30. These are the Dow Jones Industrial Stocks, the DJIA. It's 30 stocks that are a index of American manufacturing and big industry. The S&P 500, the Standard & Poor's 500, that's a basket, a index that represents the S&P 500, which are the 500 biggest stocks. Sorry, I shouldn't say that. The stocks of the 500 biggest companies in America. So the S&P 500 is attempting to mimic a big market, the broad market. NASDAQ mimics a tech sector. You can have index funds and baskets and indexes that mimic geographical, asset class type, sector. There's energy funds, energy indexes. There's Asian stock indexes. They can mimic a geographical sector, a size, an area, big or small companies. However you can slice and dice a market, you can put together a stock index to mimic it, okay? Generally in this class, I'll mainly refer to the S&P 500. That's the most common stock index. It's considered because it tracks the 500 largest publicly traded firms in America. It's considered to be a very, very reliable proxy for the state of the economy as a whole. I shouldn't say the economy, pardon me, for the state of the stock market as a whole. Okay, so that's what we're going to look at. So that's our first thing, stocks. We have bonds. A bond is simply an IOU. Okay, companies, governments, and other entities, they have to borrow money, maybe to finance new projects, maybe to pay existing debt off. Whatever reason there is, many different entities, primarily companies, governments, and other entities, they need to borrow money. Bonds are how they borrow money. A bond is just an IOU, okay? When you buy a bond, you're loaning your money to the entity, and they're promising two things. They're promising to pay you back the money that you lent them, and they're promising to pay you interest periodically until they pay you back, okay? So bonds, in this sense, they provide investors with fixed returns in the form of the interest payments. Now, bonds are far less risky. They're still risky, but they're far less risky than stocks, and therefore they have lower overall return. Going back to my spaceship analogy, if you think about a rocket, a space rocket ship, the rockets, the engines, those are the stocks. They propel it. You can think of bonds as the stabilizers. They keep it level. They prevent the volatility. And that's the role that bonds have in your portfolio. Cash and cash equivalents, as we know, are liquid and safe, but offer very low returns. This can include either cash in your actual brokerage account, as well as securities that you own, like CDs or money market accounts that are like cash. These are going to be very, very low risk, since there's very little chance of losing your money. But again, risk-return trade-off, there's going to be very low returns. A lot of financial experts question just how much cash you should have in your investment accounts. Many investment professionals say you should not have much cash at all because cash in your investment account isn't growing. It's just sitting on the sidelines. Okay. Now, those are the big three. There are also a couple of others I want to address. There is a whole class of what we would call alternative investments. Alternative investments into assets like real estate, into advanced stocks, stock tools like options or derivatives, in currency and cryptocurrency, in commodities, in precious metals, in art, in baseball cards, in fine wine, in racehorses, and everything in between. I wanted to bring this up because it's important that you know that they exist. The most I would talk about in this class will be real estate, but just be aware that there are other alternative investment options. And then finally, I want to bring up mutual funds. Mutual funds are, technically speaking, not a separate type of investment tool, because a mutual fund and its cousins, the index fund and the ETF, but mutual funds are basically financial instruments. And here's the key. A mutual fund pools money from lots of different investors. So they'll go to me, and I'm not a millionaire. Like, I'm a thousandaire. So I can invest $100. And maybe that guy can invest $100, and you can invest $100. But the mutual fund will pool money from lots and lots and lots of investors. It will pool that money into a common mutually owned fund of money. And then the mutual fund will take that big pool of money that all the many investors have contributed and use that pool of money to buy a variety of other assets. So some people do consider mutual funds to be a separate category. I guess you can, but to me, it's really not, because ultimately mutual funds are just pools of money, but they're still investing in the types of assets that we identified previously. Mutual funds, I am a big fan of, and we'll return to them later in this lecture, because ultimately mutual funds give small investors like you and me access to a far more diversified portfolio than you can create on your own. Okay, because it allows lots, it's like insurance in a way. It allows for risk to be pooled, because mutual funds don't just take all the money and buy one stock. They buy lots and lots of stocks and lots of assets. And as an owner of a mutual fund share, you own a little sliver of all of those assets that the fund owns. And that builds in for you automatic diversification. And that's good. Okay. Asset allocation. It's another big term. So we know that there's lots of different asset classes. Asset allocation is simply the division of your investment dollars across the different assets. So if you think about your investments like a pie chart, you know, maybe you've got this much in bond and that much in cash and this much in stocks and this much in mutual funds. That's your asset allocation. It's like a pie chart. It's typically expressed in percentages, but ultimately asset allocation just refers to how you take your own investment dollars and how you deploy them across the different assets. That's all there is to it. Now, asset allocation is very important because it's very much tied to risk and therefore to return. Think about my little pie chart here. If I were to get rid of some of my stocks and buy more bonds, my stock slice would get smaller, my bond slice would get bigger, and by holding more bonds and less stocks, I'd be less risky, but I'd have a lower return. Or maybe you'd say, no, Eric, I'm young. I'm going to have almost all stocks and mutual funds and very little bonds. I'm going to be much more risky, but hope for a bigger return. So your asset allocation is tied to your risk and your return. It's generally, therefore, your own personal asset allocation. It's a choice that you have to make. And that choice will generally be tied to your own unique risk threshold. Basically, every investor, me and you, we have to make a decision. How should we allocate our assets? How much should go to stocks? How much to bonds? How much to mutuals? How much to cash? How much to alternatives? It's going to be tied ultimately to your ability and willingness to accept risk. If you have a higher risk threshold, you'll probably have an allocation that is more stock and stock mutual fund heavy. It's going to be probably riskier and probably also have a bigger return. Okay. Notice that a big part of this is your age. It's important to understand that for most investors, asset allocations pivot as they get older. So for most investors, when they're younger and they have decades ahead of them, they say, hey, I can accept more risk right now because I have time. They'll be very high in stock and low in bond. But as they get older, as they get closer to their retirement, as their window of investing gets shorter and shorter, that means that they have less time to offset bad periods, so they become less risky. So over time, the assets pivot. And you'll see as you get older, you'll start to carry more bonds and less stocks. Okay. I also want to talk about portfolio rebalancing. Think about my pie chart up here. Suppose that you say, okay, I want to have 50% mutual fund, and I want to have 20% stock, 10% bond, and actually I'm going to say 20% bond and 10% cash. Let's just say you have that, right? So you have 100%. Well, in any given year, some of your assets will outperform others. So let's say that this year stocks and mutual funds have a really, really, really good year. Well, that means that this and this will grow faster than these two. They might all grow, but if your mutual funds and stocks grow faster, then without even trying, maybe a year from now, you might be at like 60, 25, 15, 60, 70, 80, 90. Actually, I'll make this 10 and 5. 60, 70, 80, 90. Yeah. Notice that you haven't bought or sold anything. It's just the fact that some assets outperformed others means that your pie charts get messed up. Portfolio rebalancing is a process in which you periodically buy and sell assets to get you back to your target. So if this were to happen, you would say, okay, I'm going to sell off some of my mutual funds and some of my stocks and use those profits to buy some bonds and some cash instruments to get myself back to my stated 50, 20, 20, 10 goal. Okay, that's called portfolio rebalancing. You want to do that like every year, every 2 years. And finally, we have diversification. Diversification is basically both an important word and a strategy. Asset allocation was about how much goes to stocks and how much goes to bonds, for example. But diversification means how you spread your investments, not just across, but within asset classes. So suppose, once again, let's just say that this time you have a portfolio and you want to be 40% bond, 60% stock. That's your asset allocation. But if you just buy shares in one company and buy bonds from one other company, you're allocated, but you're not diversified. So diversification means that within this stock sliver, you buy the stocks of many, many different types of companies. Some bigger, some smaller, some in the energy sector, some in the finance sector, some in the manufacturing sector, some domestic, some international. You spread your eggs into many baskets, and you do the same thing with your bonds. You would diversify your bonds. You would buy many different types of bonds, maybe government bonds, maybe corporate bonds, maybe short-term bonds, maybe long-term bonds, maybe domestic bonds, maybe international bonds. By being both allocated across sectors and diversified within sectors, you're going to be able to reduce your portfolio's exposure to risk. Now, diversification is interesting because here's the weird mechanics of it. In the short run, being diversified may not maximize your returns. Let's just say, for example, make this up here, that last year, the market returned an 8% average. And let's just say that I'll make up a company here, Microsoft returned 22%. Well, if I own a stock market index fund, in other words, if all of my stocks are held in an index fund and I own many types of stocks, I'm going to earn 8%. I'll match the market. Suppose that you had all your eggs in Microsoft stock. You would laugh at me and say, Eric, you're a sucker. You only got 8%. I got 22. Well, of course you did, because you only owned one stock. All your money was in that one basket, and that basket happened to do exceptionally well. But that basket might not do well next year. So just bear in mind that diversification may not maximize short-term returns, but over a long period of time, when you're talking about total ongoing volatility and sector changes and just the dynamics of the marketplace, a diversified portfolio will typically outperform a more focused one, okay? So that's important. And then the final thing to point out is it's really not always easy. If you're going to try to buy individual stocks and bonds in order to build a diversified portfolio, it's not as easy as it looks. In fact, one of the biggest errors in investing is that a lot of people think that they're properly diversified when they're not. I know, for example, I've dealt with clients who will have they'll say, Eric, I'm diversified. I say, tell me why. And they say, oh, I own 10 different mutual funds. It's okay. But then you dig a little bit deeper and you find that all 10 of those mutual funds own the exact same stocks. So you own 10 different funds, but those funds own the same things. And therefore, you don't have diversification, because if those individual stocks get hurt, all 10 of your funds are going to tank out. So just be aware that diversification is very important. It's not always sexy, and it's not always easy. One of the biggest errors that you can make, though, is thinking that you're diversified when you're not. Okay, now let's move on. So we know about some of the things to do. Let's talk now about some things things to also do, but a deeper sense. Another important principle of investing is you need to minimize your fees and costs. I will simply leave it at this. The fees that you pay, and by fees, I mean investment and portfolio fees, annual fees to your mutual fund, transaction fees for buying and selling, all the different fees that you can pay. And if you look here, there's a lot of them, okay? Wall Street has developed lots and lots of ways to charge you lots and lots of fees. I will simply say this. Do it again here. The fees that you pay will have a massive impact on your returns. And ignoring fees is a costly, dangerous mistake. You must pay as little in fee as possible. Now you might be saying, but Eric, you get what you pay for. I don't know about that. Research suggests in personal finance that high investment fees do not generate higher returns. So it's not like, oh, this mutual fund has a higher expense ratio, it's got to be better. No, not necessarily. Let me give you an example. I want you to consider that you make a one-time $100,000 investment. It earns 7% a year over 30 years. How will you do? Well, you can do it. You know the tools. Put it in the calculator. PV is 100,000. I equals 7. N equals 30. We're going to make it a one-timer, no PMT. And future value is what we're going to solve for. Let me give you 3 scenarios. I'll do the work for you. Case 1. Excuse me. If your portfolio had no investment fees at all, and you captured and kept the full 7%, after 30 years, your portfolio would grow to 761, 225. Not bad. Now let's say that you have a mutual fund with a fairly low, still high, but a fairly low expense ratio of 0.25%. By the way, I use this term expense ratio. For a mutual fund, which is what I suggest you invest in, the expense ratio is the percentage of that all your fees add up to. A mutual fund's expense ratio adds in all of their fees. So it's a nice little shortcut summary you can look at to say, am I getting the best bang for the buck? If you have a relatively low expense fee of 0.25%, after 30 years, you'll have 709,637. This should be shocking to you because most people would think 0.25% is nothing. It's low. It's a tiny little fee. Well, guess what? It's going to cost you over 50,000 of your dollars. And what if you're a real sucker and you pay a 1% fee? You might be thinking, 1%, how could that hurt me? 1% is nothing. It's tiny. I'm keeping 99%. Well, guess what, Buttercup? If you pay even a 1% fee at the end of 30 years, your portfolio will have $574,349. You will be giving up almost $200,000. You're thinking, Eric, that cannot work. There is no way that math holds. You don't believe me? Do it yourself. Go to your financial calculator and plug in all of those parameters. And then for this one, make your N equal, sorry, pardon me. Make your I equal to 6.75%. That's 7 minus 0.25. And for this one, let your I equal 6%. Run those numbers, and there it is. If you're still thinking, Eric, that's amazing. How does that happen? It's because you're not just paying 1%. That 1% fee that you pay every year compounds. And remember from TVM, the same forces that protect and grow your money when it's yours work against you when it's not yours. You're not just paying 1%, that 1% compounds. What's the moral of this story? Here's the moral. Let's say that you thought, because you slept through this lecture, that a 1% fee that's just fine. It's only fair. Over the course of 30 years, you will have put up 100% of the capital. You will have taken 100% of the risk, but you will have only cleared 574,000 of 761. Let's do that real quick. 574,349 divided by 761,225. 75.4%. Here's the moral of this story. Even with a low 1% fee, you're a sucker. Because you're putting up 100% of the capital, taking 100% of the risk, and at best, keeping 75% of the money. And that is not a way to get wealthy. So let's start now to circle and bring this home. We've established several things up to now, and I thank you for sticking with me. We've established that you cannot time the market, you cannot beat the market, you don't want to chase performance, you want to have an appropriate asset allocation, you want to be diversified, you want to minimize fees, maximize return, and you want to have a life outside of personal finance. Great. So how can you actually do this? And fortunately for you, there is a tool. Remember, I had said at the beginning of my term, of our time together, I had a lot of different mantras. And one of my personal finance mantras is you want to find the right tool for the job. Remember that. What job do I want to solve? What's the right tool for the job? Well, guess what, friends? In personal finance, in investing theory, we have the right tool for the job, and it's called a mutual fund. A mutual fund is, as we've said before, it's a type of investment vehicle. A mutual fund works by pooling money from many investors and then taking all that money and then using that money to buy a variety of assets. And the key word is variety. When you buy shares in a mutual fund, you gain part ownership of all of those various assets. And variety implies diversification. Imagine a mutual fund collects all this money and buys 35 different stocks. You, as a mutual fund owner, own a little share of all 35 of those stocks. Now, in a given year, some of those shares might go up and some might go down, but by being diversified, you're protected. These things are popular for many reasons. Mutual funds are popular because they're very simple, they're convenient to buy, they're easy to research, and the big thing is they can potentially provide really great diversification with really, really low expenses. So they're a great thing. Now, I have to point out, not all mutual funds operate the same way. Some mutual funds follow active strategies. You want to avoid those because those mutual funds will be plagued by the same problems, mainly high expenses and high fees and high churn and turnover that plague all active investors. So we want to use mutual funds, but we want to use the right type. And that right type is what we're going to call an index fund. Earlier, we spoke about market indexes. We said that a market index was just a collection of stocks designed to mimic a particular market. Well, here's what an index fund is. An index fund is a specific type of mutual fund that simply buys the stocks or bonds or other assets that make up a particular index. In other words, an index mutual fund simply buys assets in order to mirror the composition of and match the performance of that index. It basically follows a mimic strategy. I'll give you an example. The most common type of investment for new investors are S&P 500 index funds. How's it work? Well, we know that the S&P 500 includes the stocks of the 500 largest companies in America. An S&P 500 index fund takes money from all the investors, some big investors, some small investors, big chunks of money, small chunks of money, doesn't matter. It pools all that money, and then the fund takes that pool of money and purchases those 500, it purchases shares of stock in those 500 companies in the exact proportion that those companies are in the index. Then in turn, when you buy a share of that S&P 500 fund, you have partial ownership of all 500 of the stocks in the index. If the index goes up by 12% this year, since you are owning a mimic of the index, your portfolio goes up by 12% and go the other way too. If the market falls by 20%, you fall by 20% too, and that happens. But the point is, you are simply trying to mimic and match the performance of an index. This is, to me, a beautiful, simple, and elegant strategy for first-time investors. It allows you to follow a passive strategy. It allows you to own a piece of an entire market. It allows you to build in diversification. It allows you to earn strong returns over the long run. And because these index funds follow a passive strategy, you're going to get all that with really, really low investment fees, meaning you're going to keep as much of your money as you can, and Wall Street gets as little as possible. That's an index fund. And finally, I want to take you one step further. So we've gone from mutual funds to index funds. And again, index funds, that's really where you're going to want to start. But in recent years, we've actually seen another financial innovation, another investing tool. And this is an investing tool called a target date fund. Here's what a target date fund is. I want you to imagine that I decide, okay, I'm in my 50s. I'm going to be investing for another 20 years. So suppose that I decided that I wanted to have a portfolio that was 30% bond and 70% stock. So I wanted to be on a 70-30 allocation. Now, clearly, I am not going to buy individual stocks. So what I would do is I would buy a stock index fund. This is what I do own. In full disclosure, I own a mutual fund called VFIX. This is the Vanguard 500 index fund. So this is a index fund offered by Vanguard that mimics the S&P 500 market. That's all it does. That's where my money's at. I'll tell you right now. But going back to my thing, and then I would want to buy a bond index fund. So notice that I can still be diversified through index funds. I could own like two, a stock index fund and a bond index fund. But remember, every year I got to do portfolio rebalancing. And we had said that when you're younger, you can be a bit riskier. But as you get older and you move through time, you got to be a bit more conservative because you have less time ahead of you to offset market fluctuation. So most investors will start off when they're young, heavy stock, low bond. And as they move through their life, they slowly pivot it. Okay? Well, here's what a target date fund does. Number one, a target date fund is what we would call a fund of funds. It basically owns several different index funds, usually a domestic stock and a foreign stock and a domestic bond and a foreign bond fund. You think, so what? I can do that myself, and you can. But here's the key. The target date funds automatically do the allocation for you. In other words, as you get closer and closer and closer to your retirement, these funds automatically move you toward more conservative bond holdings and out of more risky stock holdings. In other words, the fund assumes that you're going to retire in a certain year. And then every year, as you get closer to that year, it simply pivots you out of stocks into bonds. A little less risky, a little more conservative. They do all your asset allocation, all your rebalancing for you. They're great. They're very easy. If you're interested in these, you look them up by the name of the fund. So like, let's say that it's currently, I'm 51 years old. Let's say that I want to retire in 20 years. So I want to retire in 2044. Then I would look up the 2040 or the 2045 target date fund. That's what it's called. It's called Target Date 2040, Target Date 2045. Let's say that you're watching this and you're 20 and you say, oh, I'm not going to retire for 50 years. So you're going to retire in 50 years. That's going to be roughly, 20, let's say 2070 to 2075, I guess. You would investigate Target Date 2070 and Target Date 2075 funds. So it's very easy. You figure out the year that you're going to retire, and that's the name of the fund that you buy. Beautiful. Okay. Notice again, we're looking for the right tool for the job. Final thing I will say, and then we'll move forward. I had shared with you in an earlier slide the idea of the different types of accounts, including non-retirement brokerages or retirement accounts. I will say to you that index funds go great with this. You can invest in index funds through either your own non-brokerage account or through a retirement account that you set up or through a retirement account set up by an employer. So these index funds, they're really super easy and almost you can invest them in almost any vehicle, thus bringing their simplicity and the diversification to your personal accounts, your employer accounts, your retirement accounts, everything else. It's not hard to do. You could probably do it in about 15 minutes. If you wanted to get started, you do this. You choose your investment platform, right? I'm with Vanguard. You can choose Vanguard, Fidelity, Schwab, T. Rowe Price. It's up to you. Pick your platform. Go online and open your account. Click a few keys. You'll need your social security number. Click some keys, set up your account. They'll issue a username and a password. Great, you have an account. Now you're going to connect your investing account you're going to connect that to your checking account. Remember the money map. You need to link those because you need to fund your investing account by transferring money from your checking account. Once your investing account is funded, step 3, you do your research and decide what you want to buy. I'm going to assume after this thrilling lecture that you're going to want to buy an index fund, but you can invest where you want to invest. That's not my job to tell you, but you decide what you want to buy. And then you click a few buttons and you buy the shares. And now you're an investor. Congratulations, and get ready for a fun ride. Okay. I will say to you that if you can do index fund investing and combine that with automation, you will be set up for long-term success and you will grow wealthier, right? You will grow wealthier in your future than you can imagine right now. Okay. Let's wrap this up. In an earlier slide, I had used the term sucker's bet and performance chasing. And I said that chasing performance to find the next winner. And I used the term, it's like trying to find a needle in a haystack. So let me offer you a fun thought. Here's an idea. Don't look for needles in haystacks. Make your life simple. Just invest in a boring, plain vanilla, no load, low fee index fund. Buy an S&P 500 fund. Buy a fund like VT SAX, which is the Vanguard Total Stock Index Fund. So S&P 500 was Vanguard's VFIAX. They also have a fund called VT SAX. I'm not endorsing them. That's just what I've owned. So I share you my knowledge. But here's the point I'm making. You don't got to chase needles in haystacks. Just invest using boring, plain vanilla index funds. And by definition, you'll own the whole damn haystack. And you don't have to search for needles because you'll own the whole market. And that's how you get successful. I'll leave you with 2 final slides to teach you 2 advanced strategies. These strategies are called DCA and DRIP. Index fund investing, which I'm a big advocate of, it goes hand in hand with the strategy called dollar cost averaging. Dollar cost averaging. When you think of dollar cost averaging, think of annuities from our time value series. Here's what dollar cost averaging is. When you engage in dollar cost averaging, you automate your investing system so that periodically, maybe every paycheck, maybe once a month, maybe once a quarter, whatever it is, it doesn't matter. But you automate a system so that periodically a set amount of money is automatically contributed to your portfolio, again, at regular intervals. You don't care if the price is high or the price is low. You just put a little bit in periodically. Because think about what that does. Anytime the market is falling and the prices of the market are lower, your fixed contribution buys you proportionally more assets than before. It's like getting Wall Street on sale. So go with dollar cost averaging. It's a great way to systematize your life. It's a great way to automate PYF, pay yourself first. It helps you to be disciplined, to be efficient, to maximize your time in the market, and to buy more assets when the market is down. You think that's counterintuitive? Yeah, but what's the rule? Buy low, sell high. So when the market falls, you want to keep kicking money in so you can buy those assets at a relatively lower price. This, in the end, lowers your average cost per share. And by definition, if you have a lower average cost per share, when you finally sell, you have higher asset appreciation, higher return. That's DCA. And finally, DRIP. Index fund investing also goes hand in hand with DRIP. The D in DRIP stands for dividend. Now, briefly speaking, we had said earlier, we talked about current income. And we had said earlier that when you own some stocks, the companies that you own stocks in will pay you dividends as a reward for owning the stock. When you get a dividend, it's paid to you in cash. And a lot of investors say, thank you very much. And they take that cash and they buy stuff, which is fine. It's a good move if you want. But here's what DRIP is. With DRIP, you take that dividend that you were paid, and instead of taking it as cash, you simply automate a process to where that dividend is used to automatically buy even more shares of the stock or the mutual fund that gave you the dividend. So, for example, I own VFIAX. Let's say that they give me a dividend this year. Instead of taking the dividend in cash, I take the dividend and I use the dividend to buy more VFIAX. Well, that more VFIAX will then pay me more dividends. And then I'll have even more cash that I can reinvest to get even more VFIAX. If this sounds familiar, it should. We're talking here about compounding. What DRIP allows you to do by leaving all your money in and having all your money work for you, DRIP allows you to fully compound your returns over time. And that, my friends, is very powerful. So I want you to imagine what you could do now with this knowledge. You set up an account, set aside some money every period, you automate a DCA, you have your Roth IRA, for example, you contribute money every month, you buy some index funds, passively managed, low fee. They're going to grow some years a lot, some years they'll lose money, but over time they'll grow slowly but steadily. You'll engage in DRIP to reinvest it. You'll get the full compounding. And before you know it, you'll be breaking into the 100,000s and the millions because time is your friend. If I can do this, you can do this. And that's the last thing that I'll say. You can do it if you choose to. The final lesson, the final principle in being a good investor, focus on what you can control. You cannot control your rate of return. Can't. You cannot control interest rates. You cannot control what the market does. So let it go. Take a stoic approach and focus on what you can control. But here's what you can control. You can control your personal savings rate so you have more money to invest. You can control the fees and expenses you pay so you keep more of your money. You can control whether you DRIP. You can control whether you DCA. So identify the things that are in your control and focus on those and just do the best you can. If you think of it this way, you'll have a very, very humane investment philosophy. You'll see the importance of running net cash flow positive. You'll live within your means. You'll make smart choices. You'll live a disciplined life. You'll love future you. And you'll look forward to a time when that beautiful future you will have a great nest egg of money to live out and fulfill some fantastic goals. In addition, following all those things on top of helping you do the good things well also helps you to avoid the dumb errors that many active investors get themselves involved in. And that's our lecture. Once again, you're going to want to keep it simple and minimize motion by following a passive strategy. I taught you to trying to beat the market, time the market, or chase performance. You're going to understand what is meant by asset class and risk reward trade-off, allocation and diversification and rebalancing. You know now to minimize your fees. You know that the simplest approach for new investors, and by simple, I also mean powerful, is to simply use index funds and take advantage of DCA and DRIP strategies. You're going to focus on what you can control, and you're going to develop a boring plan. You're going to automate that plan, and you're going to follow it for decades. That plan, by the way, is what you would call your personal investment policy. And it's a simple bullet point list where you answer a few different things: your objectives, your philosophies, the vehicles that you'll use, which we discussed, your thoughts on allocation, diversification, and rebalancing, and how you're going to systematize and automate your life in your investing. Follow a plan. Make it boring. Make it simple. This doesn't have to be a long essay. A few bullet points and you'll be there. Just put some thought into your future. Find the right tool for the job. Develop a great, boring plan. Automate it and avoid kicking yourself in the ass. You do all those and you'll be successful. And that's my wish for you, because you deserve success. You're good people. You have good futures ahead of you. You have great goals, and I want you to achieve them. Finally, some inspirational words of wisdom. John Bogle should be a saint in my mind. John Bogle was a Vanguard executive who invented the index fund. John Bogle invented the index fund, says, investing is not nearly as difficult as it looks. Successful investing involves doing a few things right and avoiding serious mistakes. Famed investor Warren Buffett: the stock market is a device for transferring money from the impatient to the patient. So which will you be? The patient or the impatient? The capitalist or the consumer? And finally, renowned military theorist Karl von Clausewitz: the greatest enemy of a good plan is the dream of a perfect plan. And I tell you this because a lot of you will be tempted to get around to investing one day, sometime in the future, when I get it all worked out. Wrong. Don't let perfect be the enemy of good enough. An 80% effective plan that you execute today will be better than a 100% perfect plan that you execute sometime in the future, if ever. With those words of wisdom, my friends, I thank you for your time. I wish you the best of luck. Wealth is out there and you deserve it. Go get it. Good luck. Long live liberty.